Back then, Ike Furcan Batista from Brazil was a billionaire who amassed significant wealth. However, his fortunes were downturned due to financial missteps, which made him the first negative billionaire. In this video, Warren Buffett, the eighth richest person globally and chairman of Berkshire Hathaway, discusses the 10 common financial mistakes investors make and offers guidance on how to avoid them. The first mistake that most investors make is timing the market. Many people think they can buy stocks when prices are low and sell when they're high, but this is hard. One significant risk of trying to time the market is that your emotions can get in the way. For example, the market suddenly drops and you get scared that you'll lose all your money. You might sell your stocks in a panic, only to see the market go back up later. Or, when things are going well, you might get too excited and buy many stocks, only for the market to crash soon after. Another issue with market timing is that it can lead to making too many trades, which costs you money in fees and taxes. Buying and selling stocks can eat into your profits and make it harder to grow your investments. In fact, a 2023 study tried 720 different ways of investing in various stock markets using 3 common timing signals. Surprisingly, 96% of these methods didn't do better than just holding onto the stocks. The few strategies that did well were mostly just luck. Instead of worrying about market forecasting, focusing on the basics of the companies you're investing in is better. This means looking at things like how well the company is doing financially, who's running it, how it compares to its competitors, and what its plans are for the future. The second mistake you make is in risk perception. Thinking that risk is only about how prices go up and down in the market rather than realizing it could mean losing your money for good. Warren Buffett once said something brilliant. Risk comes from not knowing what you are doing. If you jump into investing without knowing what you're getting into, it's like driving blindfolded. You might crash. Market changes, where prices of investments like stock and bonds go up and down suddenly, can be scary and make people nervous about their money. But those ups and downs don't always mean losing money forever. Losing money more seriously happens when an investment's value drops significantly and doesn't bounce back. This can be because the company behind the investment is struggling or significant economic problems exist. Do your homework. Look closely at the value of an investment, how it's doing compared to others, and what could go wrong. You can lower the risk of losing money for good. Another mistake you make as an investor is that you over-diversify your portfolio. It's wise to spread your investments across different things so you're not risking everything in one place. But be careful not to spread yourself too thin by investing in too many other things simultaneously. If you have too many different investments, the good ones can't make as much money because the bad ones drag them down. Even if some do well, the not-so-good ones can hold back your overall money growth. When you have a lot of different investments, it can get confusing to keep track of all them. Moreover, owning lots of investments can be expensive. You might end up paying more in fees and other costs, which can eat into the money you make and make your overall profit smaller. Focusing on a few high-quality investments offers several advantages. Firstly, it increases the potential to earn more money by selecting suitable investments and dedicating attention to them. Secondly, there is reduced risk as you can monitor and manage a smaller portfolio effectively. Lastly, maintaining a more straightforward investment approach allows for better understanding, thoughtful decision-making, and a more straightforward investment strategy. The fourth mistake that investors make is day trading. In the world of investing, there are 2 main roads to take: day trading and long-term investing. Day trading involves quick buying and selling for potential fast gains. Still, without a solid plan, it can be risky and lead to significant losses. On the other hand, long-term investing focuses on quality companies and holding on to investments for the long haul. By looking at a company's performance and industry trends, you can benefit from steady growth and ride out market ups and downs. Remember, even legendary investor Warren Buffett doesn't engage in day trading. Instead, he follows a long-term investment approach that has made him one of the most successful investors in the world. The fifth mistake you tend to make as an investor is avoiding investing more in improving your skills and mindset. Investing time and effort into improving your skills and mindset to become a better investor in the long run is essential. By honing your abilities and cultivating a positive mindset, you equip yourself with the necessary tools to make sound investment choices and seize opportunities in the ever-changing market landscape. Investing doesn't have to be complicated for you in 2024. You can easily navigate the investment landscape using the appropriate tools and resources to oversee your investments effectively. Begin your investment journey today by opening an interactive broker's account using the first link in the description. a top-notch, user-friendly online trading platform for beginners that offers direct access to global stocks, options, futures, currencies, and funds. When you sign up for an Interactive Brokers account, you can trade without paying any commissions and even get a free stock worth up to $1,000 with a free account. You can earn up to 4.33% on any money you haven't invested yet, giving you quick access to your cash. With their smart trading technology and tools, you can trade fast and at a good price in 150 markets across 34 countries and trade in 27 different currencies. Moreover, Interactive Brokers have tools that help you manage your account and trading easily. Open an account, start trading, and watch your investments grow. The sixth mistake you tend to make is that you can't control your emotions while investing. Ever felt like your emotions get the best of you when investing your money? It happens to a lot of folks. We often think of being super bright as the way to making money with investments. But here's the thing, your feelings play a huge role too. Let's talk about fear, greed, and overconfidence. These emotions can mess with your investment decisions. If you let your feelings guide your investments instead of using your smarts, things can go south quickly. When the market gets rocky, fear can make you want to sell your investments fast to avoid losing more money. But acting out of fear in the short term can mess up your long-term money goals. Suppose you're too confident in your ability to predict where the market's going or pick winning investments. In that case, you might take on way too much risk. To avoid emotional investing blunders, make a solid plan, think long-term, spread out your investments, and stay informed without letting emotions take the wheel. The seventh investment mistake that you make is that you have poor asset allocation. Asset allocation refers to distributing your investments across different asset classes, such as stocks, bonds, real estate, and cash. The issue with always following the same plan is that the investing environment is subject to continual fluctuations, influenced by economic shifts, market trends, technological advancements, and regulatory changes. If you always stick to your regular plan, you might not get huge profits on your investments. Start keeping an open mind for unique opportunities. Consider being more flexible and open to new ideas with your investments. Be on the lookout for great deals, and don't be shy about switching things up if a fresh opportunity looks promising. The eighth mistake that investors find themselves making is poor growth stock evaluation. Investing can be exciting, especially when you hear about those growth stocks with big promises. But blindly jumping into these stocks without a good look can lead to trouble. It's like buying a fancy new car without checking if it runs smoothly. Do you remember a company named Enron that caught the attention of many investors and turned out to be a Ponzi scheme? You see, Enron did some tricky stuff to hide its debts and risky things it owned from people who invested in it or lent it money. The results were pretty bad. Enron's shares, which used to be worth a lot at $90.75, crashed to almost nothing at 26 cents when it went bankrupt. And even after it went bust, it still had to give back a massive amount of money, over $21.8 billion, to people it owed between 2004 and 2012. Before investing in any company, look into how the company grows, what sets it apart from its competitors, and whether its success seems sustainable. For instance, if a company's growth is mainly because of a short-term trend or a one-time event, it might not be a safe bet in the long run. The ninth mistake that investors tend to make is following the herd. When lots of people do the same thing in investing because everyone else is doing it, that's called herd mentality. It often happens when people get greedy or scared and choose based on what others are doing, not on what's best. Think about when many people invested all their money in something because everyone else was doing it, like when many people put all their savings in internet companies in the late 1990s or in houses in 2008. People got so excited that they ignored warning signs and lost a lot when things crashed. Following the crowd blindly can lead to repeating the same mistakes repeatedly. When something becomes really popular to invest in, more and more people join in, making prices go up a lot. But when the trend changes, everyone rushes to sell, causing prices to plummet. Sometimes going against the crowd and thinking differently can help you find the great opportunities that others miss. Don't get swayed by what everyone else is doing. It's essential to trust your own judgment and research when it comes to investing. After all, you wouldn't want to follow a crowd off a cliff. Another mistake that investors make is holding cash. You've worked hard for your money and are probably worried about investing it or starting a business. You're scared of losing all your savings and seeing your money disappear. You see, when you leave your extra cash in a savings account or lie around, your money might lose value. When you have some extra cash ready to go, you can jump on exciting opportunities that come your way. This is the time for you to start making money while you sleep. Start a business now. Or, do you have a skill or service you want to sell? Workity.com is the place for you. It's a free platform to advertise your business and display your services to a broad audience. You can post your first service ad for free and reach more people. Use Workity's free listing directory to boost your sales if you have digital products to sell. Sign up now and get started. Taking that extra cash and putting it to work for you can set off a chain reaction of your money, making more money and helping your wealth grow faster than you might think. Mastering financial skills should be easier when you avoid these investment mistakes. Say goodbye to mistakes in investing in 2024 and construct a solid financial foundation. Take charge of your financial destiny. Don't let your investments collect dust. Keep a watchful eye on your portfolio's performance. Stay agile, mitigate risks, and adjust your strategy to ride the waves of change in the market. Like, share, subscribe, and watch the next video.